caused your retirement accounts maybe to decline? They're certainly a lot more volatile than they have been. And will the temporary suspension of your required minimum distributions or a reduction in your compensation lower your 2020 tax liability? Do you think the significant increase in federal deficit creates the possibility for future tax
I would
increases?
say it's a good indication.
Yeah, I would too.
With the combination of the lower 2020 tax liability, the possibility of future income tax increase, as well as potentially lower portfolio values, current circumstances create a game changing environment. The financial planning strategy utilizing Roth conversions could look attractive for those looking to gain future cash flow taxation.
Well, you know what we say, tax-free money is good money.
Oh,
This is a great year to consider Roth IRA conversions.
mm-hmm.
Just a quick refresher of the essential characteristics of traditional versus Roth IRAs. Traditional IRAs, well, your contributions are tax deductible, and the growth inside the account is tax deferred. Keyword deferred.
Not
It
tax free.
will be taxed down the road. Your qualified distributions are taxed when you take them as ordinary income, and you have a required minimum distribution starting at age 72 now. Your Roth IRAs, on the other hand, the contributions are not tax deductible. However, all the growth inside the account is now income tax free. Your qualified distributions are income tax free. Your required minimum distributions, well, you don't have any. There are no RMDs.
Roth IRAs can be an essential part of the retirement and estate planning, and not just when funding retirement accounts. The conversion allows you to change your traditional IRA to a Roth IRA and gain when you or your beneficiary pays taxes. You can convert all or any portion of your traditional IRA.
And your taxes will be calculated and assessed based on the year in which you make the conversion. This year can be a pretty good year. We're going to discuss that. This should be a significant consideration. Any amount converted from a traditional IRA to a Roth IRA is added to your income and is taxed as your ordinary income in that year.
So I'm thinking, Rod, if someone is still working and they just have a 401k, couldn't they do an in-service withdrawal out of that 401k,
right?
convert it into an IRA,
Yes,
and then convert that to a Roth?
they could.
They could do that.
Absolutely.
Tax-free income.
Yes.
Down the road.
They got to pay tax now, but down the road, tax-free.
Okay, good. Switching to a considerable amount from a traditional to a Roth can quickly move you into a new tax bracket. Strategically converting a portion of your traditional IRA may make more sense.
This is especially so if you anticipate you're going to be in a higher tax bracket during retirement, or if your ultimate beneficiary will be in a higher tax bracket within 10 years following the inheritance.
Having a plan to pay for those taxes is also essential. In the ideal situation, you should have the ability to pay for the taxes with funds outside your retirement accounts to get the most bang for your buck.
But if you don't have those resources available to pay your tax obligation outside of your conversion, your IRAs, and your only way to convert your liability is through the funds inside your IRA account, you can still do that. You can have the funds withheld during the conversion. However, you're going to have less money working for you once you do the conversion, but either tax deferred or tax free. It's important to note that an amount withheld for taxes can be included when determining your taxable income and will also be subject to your ordinary income tax rates.
Many people are attracted to the tax-free distributions that are provided by the Roth IRA. Let's be honest, everyone likes free, yet nothing is ever that simple, especially tax provisions coming from the wonderful IRS.
from your friends at the IRS.
At the IRS.
Yeah, let me ask you, is there someone at the IRS that you really love more than your family, your beneficiaries? With proper planning, you can really help your friends and family and instead of that, your friend at the IRS.
Instead of your friend at the, I'm not sure I've ever known anyone that worked at the IRS.
No, well, they'll get to know you
I don't want
when they want to.
I don't want them to know me.
I don't blame you.
No.
Roth IRAs and the tax advantages of tax-free growth do not come without qualifications, however. One of which is a waiting period called the 5 year rule. The 5 year rule states that a Roth needs to exist for 5 years or more before you can start taking out the accumulation
Tax free.
tax free. You can take out your principal, but not your gain.
You can take out the principal for the 5 years.
Well, you have to be past age 59 and a half, but
Right.
yes,
Yes. Okay. But the gain, you can't take it out until after 5 years.
correct. Unfortunately, it's not exactly that simple, though. The 5 year regulation can get tricky as it's applied differently depending upon your individual circumstances. So always consult with a tax qualified person before you do this.
As the provision relates to conversions, each conversion has its own 5 year period of time that begins with January 1 of the year in which you made the conversion.
Yeah, good point.
If you do end up taking money before 5 years is complete, the IRS treats the order of withdrawals for Roth IRAs to start with contributions, followed by conversions, then earnings. That can get a little bit confusing, so as Rod said, probably should speak with someone to help you out with that.
A tax consultant.
True.
Yeah. We're retirement planning consultants. We're financial consultants. But if you're under age 59 and a half and you take a distribution of the profits within 5 years, guess what? 10% IRS tax penalty without an allowable exception on the amount that you converted. You cannot do a Roth conversion to avoid the 10% early withdrawal penalty. And having enough planned cash flow to cover your needs for the next 5 years is critical when you consider doing the Roth conversions.
While financial planning strategies exist and can be profitable, they are not one size fits all. Current events may have made Roth conversions more appealing for some. It is still not the right decision for everyone.
No, not for everyone, but I think it's a great idea for most people, most of the people that we talk to anyway. And you want to keep in mind, these planning strategies are based upon current retirement plan rules and income tax legislation, which could change and most likely will change in the future. The decision for a conversion should be based on an individual's circumstances and you have to consider reasonable assumptions. Well, you're listening to Safe Retirement Solutions Radio.